Okay, Josh, we should be live. Mate, I hope you're doing well. What's been keeping you busy in this latest stage of lockdown? How's the last month been in the mortgage world for you?
Look, we've actually been quite busy, which is a hard thing to say. I'm always sad with all the crazy things that are happening in the world, but as far as mortgages, we're still helping a lot of people refinance. We're still doing pre-approvals every single week. We've still got a lot of activity around, like particularly first home buyers, still coming into the fold. So we're probably chatting to around 10 different people per week getting pre-approvals. So our pre-approval numbers have actually risen to 68 now. So we've now got 68 people pre-approved and looking to buy. So I was actually chatting to my client this morning who's put an offering on a place, and he's staying strong with a certain price. And I said, look, if you go $5,000 more and it's $4.50 per week, is it worth just securing it? And he's like, all right, I'm going to go back, I'm going to talk to them, and I think it's time to move on. And I said, yes.
Yep. It's time to buy or it's time to sell. This is a great time to be transactional. I think, and we'll do our best to try and keep this as brief as we can, but there's just a few things to touch on. One of the most important things that a lot of people are going to be asking at the moment is, what's happening with the market? What is happening with the residential property market as we come out of stage 4 restrictions? There's obviously been massive amount of challenge for real estate agents, mortgage brokers, and also buyers and sellers with the way that we transact. So, so what's changed and how do you see things? And I mean, you're hearing it from both sides, vendors and sellers, vendors and buyers rather. So what's happening in your world?
Look, people always say, Josh, what do you think is going to happen to the market? Now, I always say, without having a crystal ball, we don't know the exact answer, do we? So even as real estate agents and brokers, it's impossible to know exactly what's going to happen, but all we can do is look at the historical interest rates, right? So if interest rates are tracking around 2%, and I was doing some repayment calculators just yesterday on a $1 million purchase price, an interest-only loan if you were to buy an investment property, and we're talking, $2,500 in interest, that's pretty cheap. So, if interest rates are that cheap and repayments that cheap and, it's affordable for the customer, I think you'll find the interest rates are going to keep the market quite strong. So, but without having a crystal ball, we don't know the answer because we're not here to say this is what's going to happen, but interest rates are pretty damn low.
Yeah. And we've got this great window of real estate between now and sort of the end of the year where there's typically a lot of transactions. Of course, as we're first day of spring is today. That's peak selling time, peak buying time. There's always a little bit happening. My view is I expect that to continue, and we've even seen a real uptick in the people that have been sort of on the fence about buying that have now made the decision to buy.
Yeah, absolutely. Especially if you have a look at the market has had a couple of different changes over the last couple of years with the Royal Commission happening and now COVID-19. And people sit on their hands and they say, hey, because of this happening, I'm not going to sell. Because of this is now happening, I'm not going to sell. But if it was always on their mind, they're going to sell sooner or later. And there are a lot of people, like talking to this first home buyer this morning, and I said, you say that, hey, spring's coming, there's going to be more on the market, but there's also going to be more people out there looking as well. So there's going to be even more competition. So that's going to keep the market quite strong, because all we're seeing is people who want pre-approvals for when we come out of lockdown 4.
Yep, definitely. Okay, so let's get into a little bit about specifically what you do day to day. The first question I'm going to ask you about is JobKeeper and what the impact JobKeeper is having on people's ability to either purchase new property or refinance. How do banks look at JobKeeper?
So JobKeeper has been looked at in a lot of different ways, and there was a major bank that had a policy around JobKeeper as soon as it happened. So essentially, around about 2 months ago, we really had one bank that was quite strong with JobKeeper. Now the things around JobKeeper are you getting paid JobKeeper and not actually working because there's actually no work to do? Now, if that's the case, then the bank might look at your income and say, well, we won't use that because you're not even doing the hours to earn that money. But if you're earning JobKeeper and you're actually doing those hours to actually earn that, plus you're earning more money over the top of JobKeeper, the banks start becoming more comfortable with that. Does that make sense?
Yeah. So if you're at home on the couch earning JobKeeper,
Yep.
banks are not looking at that as favourable as people that are actually still going to the office but are on a reduced income.
Correct. Yep. So
Or
that sometimes can be coupled with like another income, or you might be earning your JobKeeper plus the person that you work for is still topping your income up, so that you're still on that 55 or 60 grand wage, etc., whatever the case may be. And they'll use all of that income as well as JobKeeper. And then it's case by case as far as industry is concerned too. So they might say, okay, well, you work in the hospitality industry and you're earning JobKeeper, that $30,000. How many hours are you doing, and are we comfortable with that industry?
Right. Okay.
But there are deals to be done.
Yep. So they are doing deals on JobKeeper, which is good 100%. To know. People that are self-employed, I would expect that the way that income for people that are self-employed has changed. The assessments, that criteria is always shifting. So so how has that moved, Josh?
Yeah, so typically, once upon a time, all the major banks do different things at different times, but they would normally just you have to show the last year's tax return, or maybe the last 2 years' tax return, and then they might average those out. What the banks are now, most of the banks are now requiring trading statements, so monthly trading statements, BAS statements to back that up. So it's not just a matter of showing a tax return now. It's a whole lot more to it. Now, they're also looking if that company is actually taking on JobKeeper. How does that look?
Yeah.
Okay.
Right.
So what they are also doing, they might say, hey, well, your income's say $100,000. Let's figure out from the BAS statements how much you've actually dropped by, and they'll still use an income. So they might use 70% of that income, and then that's the income that we can use to then purchase. So it's not all doom and gloom. It's just that you can't use your whole income at the moment.
Yeah, and that's probably to be understood. We talked last month about how people that are on bonuses, how they've shifted the goalposts back and their thresholds back there as well. So that's probably understandable for them to take a more conservative approach. Josh, I had a question in relation to general affordability. Having just gone through going through a purchase myself, the way that living expenses are assessed forensically. I feel like the bank has got a squad of detectives there just mining through credit card statements and history to really understand things. So probably my two questions is, have there been any changes as a result of the latest restrictions that we've got? And the second question I've got is, what tips and advice do you have for people that are looking at those affordability and those living expenses?
Yeah, look, years ago, as a broker and a client that's looking to buy a property, the banks usually use just an exact number, actually, and most people never really thought about their living expenses. And there's a bit of a subscription problem out there, isn't there? When you have a look at Stan, Netflix, Amazon, there's so many. I think I signed myself up for an extra couple of apps per week, and we start to forget how much is actually coming out of our accounts. And it hasn't changed because of COVID. It changed because of the Royal Commission. And being honest, it needs to change because people need to start thinking what's coming in, what's going out, what can I really afford? So as a broker, it's not my job to say, you can afford this because I tell you to. You need to be able to afford that because we can show affordability. So tips and tricks. So just recently, and I think I've shared the scenario with you, a client came to me, they were looking to purchase a property. They could only borrow a certain amount based on their living expenses and what the bank was willing to give them. Now, I said to them, let's go back and have a look at your car insurance. We dropped their car insurance down by $30. Let's go back and have a look at your health insurance, and we dropped that down by $30. So that allowed them to borrow another, say, $8,000 or $9,000, which allowed them to purchase the property. So, the banks should actually be looking at these living expenses, but by having a look at it yourself and dropping a few different things allows you to purchase at a certain level.
Yeah, so it's things like going out and really assessing where your subscriptions are with those sorts of things.
Yeah.
But also, Josh, I know that, and most people that have bought would probably realise this, but people that haven't bought, and maybe some investors don't realize the impact that credit card, even just credit card limits, can have on your purchasing. What's the latest as far as that goes?
Well, credit cards, 6-7 years ago, if you could show that the client paid their credit card off every month, then we didn't actually have to use it. But now they say, okay, well, responsible lending, that $10,000 credit card, we need to assume that, let's pretend that $10,000 credit card was full. We need to service that person based on the fact that they might just grab it that one day, and then it becomes a major cost. And so it should be. So there are some people that you meet that have credit card limits of $50,000, $60,000, $70,000. So that can be a huge amount. Like that could change $200,000, $300,000, $400,000 worth of borrowing power. So we have to drop those credit card limits down.
So when you are, getting into that mode of purchasing, if you've got multiple credit cards or a significant limit, it's about reducing those limits so that when you're lodging your loan, you're in a better position to be able to finance things.
Absolutely.
Okay, so here's another topical one, and something that you and I were talking about just the other day: refinancing. I heard Effie Zahos on the Today Show last week talking about deals out there with banks and interest rates, and just cash getting thrown at people from banks looking for good deals on equity. So tell us about that, and what advice have you got as far as refinancing at the moment?
So first of all, I watch her every morning too, and I think, all right, look at all the questions that I'm going to be getting all day today, because she's not a specialist mortgage broker. She says things and I'm like, no, why did you say that? Because that's just not the case. But at the same time, she's a generalist and she's giving a lot of people information. But there is, a lot of people say, what's the best rate going around right now? Now, as a broker, you're not even allowed to say the best rate legally, by the way. But there's fixed rates of, near 2%. There's banks that are offering $3,000 cashbacks and rebates. There are some banks that are offering $3,000 cashback per property. So, recently I've done a refinance for a client, 5 properties, and he got $3,000 per property.
Wow.
So he went and collected a fantastic rate, got himself in a better position, and got a bit of a cash kicker at the same time. Variable rates are, depending on equity, you can get around that 2.5 mark. So there's some amazing deals out there, but it's all comes down to the client, their situation, who are they, what do they earn, what policy could we go with bank, and then how can we save them some money?
Yep. So just on that, I think that's a really good point. When you're thinking about doing a deal at the moment, I was speaking with a client the other day who has a fixed interest rate at the moment. About another year to go. There's obviously going to be costs in breaking it. So you're probably having those conversations on a daily basis. Have you got some general tips around people that are on fixed rates at the moment, or whether they should be fixing part of the rate or variable? Or, I mean, that's always the big one, isn't it?
Yeah. So right now, when I do talk to a client that comes in, they say, look, my loan is fixed, for another 8 or 9 months. We need to find out what the exit fee is. So that exit fee, I spoke to a client yesterday, his exit fee is $40,000.
Wow.
So I said to him, well, there's no point in even running numbers for you. Like, I think you need to stay where you are. The bank had locked all of his properties into each other. So it was, quite mangled up. But as a broker, our job is to get each client's circumstance in the best situation. So our job is to save you money. And I always say to people, if I can't save you money, you're going to stay where you are for the next year. And we've got to look at the break costs, look at the rebate that you're getting, the current rate that you're on, the new rate that you're going to be on, work out the interest savings or loss, and decide what we need to do, because it's in my best interest for you to have the best interest, right? Yeah. So, and everyone's case-by-case scenario. So a lot of first home buyers say, should I go fixed or should I go variable? And my answer is, what are you comfortable with? Okay, so there's positives to a fixed rate. The negatives are that exit fee, because rates have come down. The positives right now for a fixed rate is they're sitting near 2%, 2.1%. The variable's at 2.7. So what should you do? It's a crystal ball question, but everyone's a case-by-case scenario, and that's why you've got to look at each individual circumstance.
I mean, we had an interesting one. I know this is probably a little bit to the aside, but there's a lot of bad advice out there that is given to clients, Josh, and this is why, and there's no secret that our team work very closely with you, and you work with a lot of our clients, and you do some great work. We had a scenario last month where we had one of our team had been working really hard with a buyer for a long time that thought they had the capability to buy a property. They purchased a property from us. Yep. Fortunately for them, subject to finance, but unfortunately for our vendor, they never had the ability in the first place to even purchase the property, and that's probably something that comes up a little bit. So, if you're sitting at home, if you're watching this at the moment on your phone or wherever, you've got a mortgage, you're thinking about getting into property, you should take the time to speak to an expert, to speak to Josh and Josh's team, MAB Brokers, to get the right advice. Josh, it's fun. We're in September now, so there's a lot of people that have popped their mortgages on hold.
Yep.
That have contacted their banks and said, "Hey, look, you got to stop these repayments coming out." What's going to happen now? How are banks looking at things? How are they reacting? What's next?
Yeah, so this is all new information for us as well, because we're learning when people are putting their loans on hold, they're ticking a box saying that they're in hardship, which is why they've chosen to hold their mortgage off for 6 months. People have been coming to us over the last couple of weeks saying, I've noticed that there's a better deal out there, I want to refinance. And then by the time you gather all the information, you realise that they've claimed that hardship and their mortgage has been on hold for the last 4 months. Now, we can't refinance someone who has ticked a box saying that they're actually in hardship, can we?
Mm.
So what's happening now is when those customers come off their hardship clause, hopefully their jobs are then safe and they're feeling quite comfortable. We then usually have to wait another 3 to 6 months before we can then start looking into better rates for them, okay? Because we need to show that their loans have been paid back, the interest is being paid back, but each week these things are changing. So the banks might say, hey, this is what we're expecting. This is our policy. Because of COVID-19, our policy's now changed, okay? So that's why you and I, Baden, have been doing these sessions, because people get a little bit of information, but each week, things are changing a little bit. So
the goalposts are constantly moving, and that's the challenge. But the goalposts, Josh, are constantly moving for the consumer as well.
Yeah.
That's the sad part. Is that that there are people out there, and we're speaking to them daily from a tenancy perspective, from a landlord perspective, from a vendors that need to sell now. There is still some uncertainty. Are banks going to extend? Is your view that banks will extend people's ability to postpone their mortgage repayments?
They are saying that. So they've obviously done the first 6 months, and they are saying that they will look into doing this the next 6 months as well. So some people are ticking that box saying, well, let's just have 6 months off. They feel like it's a 6 month break. They might be getting some JobKeeper. Their mortgage is on hold for 6 months, and they see it as a bit of a holiday. Now, the bank's always going to get their interest, but the people who are in true hardship, who really need to have their mortgage on hold, if you speak to the bank, they're actually all being very, very flexible on continuing that 6 months.
Josh, how and maybe this is a question without notice, but people that have paused their mortgage repayments, $500,000 or $1 million loan or whatever it might be, what is the actual financial impact of that? Now, I know from a borrowing perspective, it's it's that they've had to tick that hardship box and they might not be able to look at purchasing, but they're actually capitalizing that interest as well, and it's not a holiday at all.
No.
It's a holiday, but they're taking money out of your account later on.
That's right. So the interest is being capitalized, really. So they're still going to have to pay that interest back. So it's not a free deal.
Yep.
The interest will add on to the loan. The banks will always get their interest, so they're still going to get their money. Essentially, you might have to pay your loan off over a longer period of time. So it's not a holiday. It's just a pause in the meantime, but the bank will still get their interest.
Yeah, and I think that's a misconception. Certainly amongst we obviously deal with a lot of tenants, and we've had tenants contact us and say, oh look, but your landlord, they can pause their mortgage repayments, but it's not a pause at all. If their mortgage was if they paused it for 6 months and their mortgage was say $500,000 and their repayments were were $1,500 a month, they're coming out of this, it's going to be $510,000. which might add years to, literally years to paying off that debt down the track. So I think that's another common misconception. Josh, just I know we want to try and keep this as brief as we can, but have you got any final thoughts? Are you seeing any other trends there that are worth bringing up? Have you got any other advice that you want to share with with the audience?
I think the best advice is to talk to someone who's a professional. Everyone's going through different circumstances. There are some people who are in hardship. There's when you then become if you're a first home buyer or a second home buyer, the best advice is to go to someone who's a professional. So obviously there's a lot of brokers out there, there's financial planners, etc. I think what we do is we listen to our family and friends, sometimes too much, because they are our family and friends, but they all have their own little way of thinking about what someone should do. Now, the best advice is to reach out and just have a chat to someone. So our job over the last 8 months has just been talking to people and giving them, hey, you can't do this right now, but this is what you might be able to do in the future. Here's some ideas based on your circumstance. So reach out to the right people for the right advice.
I think that's a really good point, Josh. And the reality is that you deal in this day in, day out. You said just before you've got 68 clients pre-approved to purchase, plus all those people that you're working with. And I know that this is one thing that I always thought was great. If you can't save me money as a mortgage broker, stay where you are. And that's and that's the attitude that that I appreciate working with. Josh, thanks very much for joining us. Looking forward to dialing in with you in another month. And for people that want to make contact with you, I'll make sure that I've got Josh's contact information in our comments box below.
Fantastic. Thanks for having us, guys.
Thanks, mate. Take care. Cheers.